Please. So class today is going to be focused primarily on FHA, but usually as I kind of just start the class, just two web pages. I usually refer to my web page, which every loan officer across the country has pretty much the same template as a web page, but feel free to check it out. There's some good information on there. The apply now button. I'm always shocked with how many people go right there before even speaking with me for the first time, but more than happy to start there if we like. So there's some good calculators, payment calculators and such, rent versus own stuff. So I do, in general conversation, sometimes we'll walk a buyer through that. So just know that that exists. And then while we're here, figure we'll talk about interest rates just because always a hot topic with your loan officer. So just to let you know, so this Mortgage News Daily, I refer to this a lot. It's a somewhat impartial. It's not like bankbreak.com where they're just trying to get you to click on ads, sell your information to somebody else. It's somewhat third party impartial, but it kind of shows where interest rates are. This little yellow bar here, I know you guys at home probably can't see this, but the yellow bar shows over the last 12 months the high point and the low point. So just to show the 30-year rate, the high point over the past 12 months is 3.45. The low point, 2.75, which is basically the lowest we've ever seen the 30-year rate. And right now we're sitting at 2.81. Now, that being said, we have job numbers report coming out tomorrow, and the bond market is going haywire. See this little black or red 23 over here? This has got Chris and I on the edge of our seats here because it was red yesterday and rates are pushing up a little bit, which is not uncommon the night before jobs number report. So first Friday of every month, unemployment numbers come out. That's one of the biggest movers and kind of the economy or the Wall Street. So anyway, that's where we see that. But anyway, 15-year sitting right now, this shows 2.24%. We could probably do 2.125% on a 15-year right now. So 15 years is a great opportunity for savings. But let me jump back. Yes, it's as close as free as we've got.
Sean, do you have a mortgage calculator on your page?
I do, yes. So
where is that? Because I'm always running payments for people. I'm not quite sure why.
Always feel free to call me.
With a big disclaimer.
Yeah.
I don't even have the multiplication tables memorized. You should not be listening to me.
We go to Resource Center Mortgage Calculators.
Okay, perfect. Does it calculate PMI?
It doesn't.
Okay.
I mean, you could put PMI in there, but it's not real reliable.
Right.
So you can just put in the price, down payment, taxes. Of course, you can just put a zero that out if you prefer. And I hate to say it, the easiest when you call me on a Saturday, somebody buyer calls me, needs to run a quick one. You just Google calculator, mortgage calculator. It'll come up with the most simple principal interest.
Yeah, well, that's what I'm doing now.
Yeah, yeah, feel free to check out my page. That's a good way to go. All right, so wait from the beginning.
And we have to go away from sorry.
Did you see that?
No, go back. Yeah, it just will pop up here. Okay.
All right.
Oh.
All right, so now we're gonna fly through the VA portion, or excuse me, the FHA portion here. My marketing people would flip out because I don't have the right colors set on the background, but oh, and I'll get stress balls to you guys. I'm sorry.
I'm gonna take a picture and send it to Eric Wilson. Done. Done. Been learned, done.
It's caught up with the AV stuff.
Oh,
Okay, so I'll probably keep repeating myself here, but don't be afraid of FHA, even in today's market. So we'll talk about, the pros and cons to FHA, the myths of FHA. We'll kind of get rid of some of those here as well. But as I usually start off all my little presentations, 14 slides. So anytime I'm seeing through any type of presentation, I want to know how many slides there are. And hit number 13 is like a blank discussion page. So we're already through the first one here. Okay, good.
You should have tally at the bottom.
FHA lending is exploding. Oh, I gotta click through each one here. So, FHA, I checked through the second quarter of this year, FHA loans makes up, I think it was either 18 or 19% of all loans. So just think, 1 out of every 4 home buyers is FHA. So I jump in there first because if we're thinking, well, I'm not going to show my house or consider an FHA offer, great, you just took out 25% of the potential market buyers to your property. FHA in 2012, 2011 made up almost 30%. If you remember why, for those of you old enough to have been in the business back then, you could get PMI. 2010, 2011, 2012, you couldn't get private mortgage insurance on a conventional loan. So it was either 20% down or go get an FHA loan. So even somebody who had great credit, 10, 15% down, had no choice but to get an FHA loan. The market, FHA didn't want that much. They didn't want that much invested, so to speak, in the housing economy. So they tidied up some rules. The conventional market kind of came back, and we're back to that 2019, 18% spot. Just quick history of FHA. FHA was created, it stands for Federal Housing Administration, was invented or created, however you want to put it, in 1934. Back then, depression happening, you needed 50% down to buy a house. Government said, well, we probably come in and step in here and see if we can't fix this somehow. And that's where they came up with FHA financing. Now, FHA financing is one of the few government programs where it's actually funded by those who use it as opposed to taxpayers. Meaning, you know, what we put in as far as out of our paychecks go in federal tax, what we pay our taxes at the end of the year, that does not fund FHA. The home buyers do by way of mortgage insurance. And we'll talk a little bit about that. So FHA, it's geared for first-time home buyers. You do not have to be a first-time home buyer. It's one of the biggest myths. A lot of buyers say, well, I've already owned a home, so I can't buy, you know, FHA. Or, you know what, my wife owned a home, so does that mean she can't go on the mortgage? No, absolutely not. You can actually, absolutely, this could be your 5th, 6th, 7th. You can have 5 investment properties. You can still buy FHA as long as it's your primary residence. I'll probably repeat that later on. Borrowers with little to no money, borrowers with less than perfect credit, we'll get into that. Not occupying co-borrowers, we'll run through some scenarios there. Top features of FHA, 3.5% down. $100,000 house, $3,500 is your down payment. $300,000 house, $11,000 or $10,500 is your down payment. Seller concessions can still be up to 6%. So on a $100,000 house, that means you can ask the seller for up to $6,000 back towards closing costs. You shouldn't need that much money on a $100,000 house, but more to the point, with most buyers, you can incorporate or negotiate it for the seller to cover almost all costs in some cases. Now, if it's a $50,000 house, that means you're going to be capped out at a $3,000 credit. Costs are going to be a little bit higher than that, but all in all, it's a great option. So the buyer can use gifted funds. So in addition to using seller credit towards closing costs, the buyer can get a grant or a gift from a family member. We're real strict on who gives the gift. It has to be a family member, and there's a little bit of wiggle room for a close family friend, but it's hard to prove a close family friend. Chris and I just challenged this with an underwriter yesterday. We have a boyfriend, not a fiance. They don't have a child together, but we somehow have to show their relationship. We're having a tough time doing that. We're going back to Facebook pictures and all of that. So she's probably going to get a gift from grandma instead, which is going to be a little bit easier for us to document. I had fiance is eligible in some cases. I had a customer send me a 3-minute video of their night out at the Cheesecake Factory where they actually got engaged. It was absolutely cute. In addition to that, the fiance also sent me a copy of the wedding ring receipt. So we got pretty good. But here we go. So these are the creative ways that we have. And each one is kind of treated kind of case by case. No reserve requirements. What reserves are, let's say that you're buying a house for 100,000, you got just enough, you got enough to close, maybe $10 left over in the bank. You'd be surprised how much that happens. Some programs require that you have extra reserves, showing that you have, extra $5,000 in the bank, an extra month in the bank. FHA doesn't require that. If you're a borderline buyer, it can make the difference and get into that program, help qualify a little bit easier, but it's not necessarily required. And there's no income limits. Some first-time homebuyer programs have income limits, but FHA does not. You can have a $500,000 income and still be fine for an FHA. And very competitive interest rates. Actually, I took down the slide there, but FHA rates, we've quoted as low as 2.625%, 2.5% even in the past 2 weeks. When rates were at their lowest towards the tail end of last year, we were locking rates at 2.25% on a 30-year fixed FHA. So as Sam said, that's practically free. He might say it is free. So as I mentioned, owner occupied only, 1 to 4 family homes. So if you're buying a home and it's 40-unit property and near west side of Cleveland or Cleveland Heights, as long as you're going to occupy that home, you can still get an FHA loan, still at 2.625%, still with just 3.5% down. That could still be a gift from mom and dad with the seller paying closing costs. There's a few extra requirements for the multifamily. We'll come into that a little bit later. Maximum loan amounts. The government sets the maximum loan amount, and it's based on the county that you're buying. So for Cuyahoga County and pretty much all of Ohio, the maximum is 350. I forgot the exact number. 350. It's in here somewhere, I'm sure. 356 or 359. So you can get an FHA loan up for that high on a single family home. If it's a 2, 3, or 4 family, it's going to be higher. So again, this is kind of a lot of people don't expect that. So FHA does not have an official minimum credit score per se. What I will tell you is that each lender may set their own credit score limit. Cross country, the way I would word it is this: if you're over 620, 640, it's not as though it's an automatic approval, but you're going to be in very good shape. If you're 580 to 620, you're kind of in that borderline zone. Very likely we may be able to make the loan, but we're going to take a real close look at why this score is where it's at. If you've got, if you're past due on your car payment and haven't made a credit card payment in 3 months, that's not going to work. Even if you got 680 credit score, probably wouldn't, but nonetheless. So at 580 to 620 is definitely where it's going to be a little bit more work. You're probably going to pay a little bit higher interest rate. You're probably going to pay a little bit higher closing costs, but we may still be able to do the loan. Under 580, I won't say it's impossible, but it's very difficult. You'll need at least 10% down right from the get-go. And, scenarios where that might work is someone has essentially perfect credit, but they've got 10 medical collections. We're pretty forgiving on medical collections, assuming there's a reason for it. And we're pretty forgiving. That's an example where we're very likely to make it work. Obviously, if somebody had a foreclosure, that's a totally different story. That's a different type of exception. So just so you know where we stand on that. That's us. Generally speaking, some lenders, I'll throw out Third Federal, they don't do FHA loans, period. Other banks will do FHA loans, but I did a loan for an underwriter at a bank here in town who is pretty well known. She had a 659 credit score, and they said, sorry, you need a 660 score. She's an underwriter, and at their own bank, they said, can't do it. So I did their loan. One of the easiest loans I've ever done, because guess what? That underwriter had every page of every bank statement. It was just sort of like, okay, what do I have to do here? But just so you know, different lenders, different requirements, want to let you know where we start. It is a flexible down payment sources. So I mentioned personal funds. You can't borrow money unless it's against an asset. So you can borrow money from 401k. You can even take a loan. I've had people take out, cash out, refinance on their car and use that as a down payment. There are some grant programs still out there. NHS, Cleveland still has a grant program. I haven't checked in the last month or see if it's still funded, but they've got that. There's the OFA program, which is a first-time home buyer program, or ideally for first-time home buyers. Community First, these are all grant programs. They have higher costs, they have higher interest rates, but there are ways to fund the down payment. I have a lot of buyers asking, saying, hey, what do you think about this grant program? The way I often word it is, you're gonna get a better interest rate and a lower payment if you can come up with a down payment on your own. If you can't come up with a down payment, it's the difference between getting into a home or not. These are great programs too. But these programs changed. The OFA program went from 3.5% to 2.75%. It's earlier this year. So they kind of come and go with, the flavor of the month.
Sean, what kind of money do they give?
So the OFA program gives a 2.5% grant. So on a $100,000 house, they're giving you $2,500 towards the $3,500 down payment. Sounds nice. The closing costs are going to be about $1,250 more. So okay, getting $2,500,
Okay.
but I'm paying, but maybe that's.
So you're really getting like 1,000-ish.
Yeah, but the seller may be able to pay that. It's hard for us as lenders because these are kind of, we got the OFA sends the interest rates and all that, so
Yeah.
we can't wheel and deal a whole lot. Or
Right.
try and credit money back.
But they're not as good as they sound.
Well, yeah, I mean, there's pros and cons to it, but if it's the difference between getting in or not, we have
Yeah.
something called the Communities First. It's a 3% rate. So you get $3,000 towards your $3,500. The closing costs are gonna be about $750 more,
Hmm.
but the rate's a little bit higher too. So I've been using
Yeah.
that program a little bit more. And there's
Community
income
First?
issues. Communities First. Yeah.
Okay. Thank you.
FHA highlights continued, manual underwriting. So with every lender out there, pretty much, when you start an application, the pre-approval, we're running your information through an automated underwriting system. Fannie Mae, Freddie Mac, in effect, FHA, VA. If this system says no, some lenders, that's it, no further, can't do the loan. We will do manual underwriting, or more, think of it as more traditional underwriting. You're actually having a human being not use the aid of the computer to decide if they could do this loan. They're making the decisions all by themselves, which is frankly what they've been trained to do. So where this comes in is if you got somebody who maybe doesn't have a credit score, we can go this route. Or you have somebody who has that 590 credit score and the automated system's not approving it, but it's a make sense deal. This is where that comes into play. We will do that. I don't say we do a lot of it. Most of our loans are going to be more than what we consider the current traditional, but we probably do as much or more than any other. Good documentation is key. Hey, you'd be surprised how far a letter of explanation will go, saying, hey, you had a foreclosure 3 years ago. We're okay with that. And I'll make sure I touch on foreclosure bankruptcy just as I zip through these if I escape by it. But an explanation of, hey, you know what, you had a bankruptcy 2.5 years ago. Things were going great. All of a sudden you had a late payment 6 months ago. What's going on? Well, you know what, the mailman, didn't deliver, never showed up in the mail. I totally missed it. Or, I had somebody write an explanation letter about their car seat. Mail kept slipping through their car seat. They pick it up on the way in, they put it here, and bills kept falling up to this mystery, void in the world where the bills would go. That was not a good letter. But you know what? I was whatever line of work, I ended up, I broke my leg, had to be off work for 4 weeks. My pay was reduced by 40%. Was able to get things back up. It's like, okay, you know what? You deserve a second chance here. I mean, it's understandable. So, and obviously with what we've seen over the last 18 months, we're seeing a lot of things sort of tied to the pandemic, and health issues and everything else. Can't say how many explanations start with, well, I got COVID, and then it goes from there. Borrowers, so let's talk about, I don't think it's coming up here. Let's touch on credit real quick. Maybe not real quick, but I talked about credit score and I said that's not the only thing. If it's 700, doesn't mean you're automatically getting a loan. If it's 590, doesn't mean you're automatically not getting a loan, but it's a big part of it. Some of the big things, milestones, or I said credit, big ones, bankruptcy. If you have a Chapter 7, conventional loans require you to wait 4 years from the discharge date. FHA, 2 years. If you have a Chapter 13, so with a Chapter 13, if you're not aware, that's where you're restructuring your debt. Basically, Chapter 7 wipes the slate clean. Chapter 13 says, I'm throwing the towel, courts help me out, have everybody stop charging me interest, and let me see if I can get a repayment plan with everybody. If you're in chapter 13 for 12 months, you could be eligible to go buy a house and get an FHA loan after just 12 months. If you've had a previous foreclosure, it's 3 years. Conventional, it's 7 years, 4 years if it's a short sale. With FHA, it's 3 years. So somebody could have had a mortgage foreclosure in 2018 and already be eligible to go buy another property. I'd say that's pretty forgiving. So obviously, if you have somebody who, through your natural sort of progression, getting to know somebody as you're showing them houses, that may or may not come up. So feel free, chime in and say, hey, another reason why you want to go out and get yes, foreclosure, 7 years conventional, 3 years FHA. Short sale, 4 years conventional, 3 years FHA. And for those of you here today, in addition to enjoying your pizza, I'll run out. I got a little cheat sheet card for you I can hand out for that. For those of you at home, feel free to pop in. The pizza will probably be cold, but stop by the office. You'll get those and stress balls. I don't know where the camera is. Make sure I get stress balls to you guys. So again, FHA overview, 3.5% down. We talked about that. Skip over the prepaids one. Seller can pay up to 6% in closing costs prepaids. Yeah, the wording, to skip through this one, but just when you're writing up a seller credit, the suggestion I always make, seller to credit closing costs, or excuse me, seller to credit X amount, either $1 or a percentage of the sale price, towards buyer's closing costs, prepaids, and or points. Closing costs, prepaids, and or points is a safe way to put it. That way, if there's money left over, if you just say towards closing costs, well, what happens if we have a $5,000 credit, closing costs are $3,000, there's $2,000 left there? We can't pay prepaids and points unless it's explicitly written out. It's annoying, but always best to put it that way. As we talked about, 1 to 4 unit. Oh, this is the other part on that. If you're buying a 2 to 4 family, we can count the rent. So I'm buying a 4 family. Let's say that I'm moving into the first unit. Unit 2, 3, and 4 are going to be collecting $500 in rent from each. That $1,500, there's a percentage of that we can count towards the income and qualify that for a higher price. So someone might say, okay, you qualify for $100,000 home, single family, $125,000 or $145,000 home because it's a multi-family and you have rental income coming in. We do take a closer look to make sure. It's a weird rule. We do require reserves, so buyer does have to have a few months extra saved in the bank if they're buying a 2, 3, or 4 family, and the property has to be self-sufficient, meaning on a 3 or 4 family, is enough rent on units 2 plus 3 plus 4 enough to cover the mortgage payment. So there is kind of a litmus test that has to be counted in order to count the rental income. So getting probably a bit too much in the weeds because usually that's going to happen. $125,000 house, your FHA payment's probably going to be below $1,000. You're probably making at least $1,000 on just 2, if not 3 units altogether. Questions on that? Okay, let's talk about mortgage insurance. This is a teaser for my favorite class to teach, having a PMA about PMI. That's having a positive mental attitude about private mortgage insurance. Chris, I mean, it's a great title. It's solid. I'll introduce Chris. Chris, by the way, I should have started there. Chris, loan officer on Team Hadley, whatever you want to call it, sits about 8 feet away from me. Carmen is still with Cross Country Mortgage. She's just worked from home. She starts early, she ends late, so she might as well just be at home anyway. But Chris is kind of, you'll see him in the mix, pop in some meetings and all that. And he's here to laugh at my jokes too. So I'm going to talk a little bit about mortgage insurance here. We're okay. I'm going to try and certainly have you guys out by 2. So just to touch on the probably sooner, by the way, but mortgage insurance. I'll tell you, I'll just try and explain it by word here since we got some people here at home. But on a $100,000 house, someone's buying a conventional and they're putting 5% down. They have mortgage insurance, PMI, private mortgage insurance. That insurance policy is probably for 30%, let's say $30,000. So from a bank standpoint, They have $100,000 house, and they essentially have $5,000 in equity, another $30,000 in insurance policy. So that bank has really $65,000 at risk should that house be foreclosed. On an FHA loan, it's 100% insured. So in the $100,000 house, the buyer's putting $3,500 down. That's $96,500 that the government is guaranteed is insured. So if that loan goes into default, the bank in essence is pretty much made whole. So banks, lenders love FHA loans because if they do them right, if there is some sort of catastrophic event, the buyer can't make payments, they do have a bit more protection than even a conventional loan. That's why interest rates are so attractive on an FHA purchase. So what FHA does have though is they have monthly PMI and upfront mortgage insurance. So you have two kinds of PMI simultaneously being charged. So on a $100,000 house, just use round numbers here. If anybody's got a calculator, don't use it now. I'm just using ballpark numbers. But on a $100,000 house, putting the minimum down, buyer pays monthly PMI, which is going to be in the range of about $60 a month. Let's call it $65 a month. That's how much the buyer pays for PMI each month, every month for the life of the loan, if they're putting less than 10% down. So one of the bummers with FHA is that PMI is permanent. Again, when you're putting less than 10% down. And in addition to that, FHA has an upfront mortgage insurance, which is 1.75% of the loan. So in a $100,000 house, they're adding about $1,650 in mortgage insurance on top of the loan. So you're buying a house for $100,000, you're putting $3,500 down, you have a $96,500 loan amount, add $1,650, give or take to that, that's what you're borrowing. So that's one of the downsides to FHA. If you want to say, if someone says, well, why should I go conventional over PMI? Well, the PMI might be a reason. It's not going to be there for the life of the loan, and you don't have to do both upfront and monthly PMI. So somebody with a 660 credit score, the PMI is going to be sky high conventional. They may not even qualify even with 5 or 10% down. So FHA is still a great option, but that's why, when I'm working with a customer, I talk about conventional. In my mind, I may know this is a conventional buyer all day long, or this is an FHA buyer all day long. I'm going to, for lack of a better term, educate them as far as what's out there so that they know, as of today, here's what's available, the pros and cons to each one. Who knows? They may say, you know what, I don't want to buy a house for 6 months. In that time, I might save up more money. I might get my credit score better, and they may flip over to other programs. So the important part is to know what the options are. Any questions on that?
Can you refinance an FHA?
You
get
can,
rid of
yes.
that once you get to the,
You absolutely. So there's no penalty to refinance on pretty much any loan that we do, FHA included. So it's a very common question of, okay, if I get an FHA loan, I'm stuck with PMI, a couple of years from now, can I refinance over conventional? Absolutely, you can do it anytime. This is real powerful. If you think of somebody who bought a house in 2018 and end of 2018, we think, rates were at 5%. So take somebody who bought a house in 2018 at 5%, put 3.5% down. We're probably having a conversation now about refinancing anyway to get to a lower rate, almost cutting their rate in half. So there's a big bonus there. For whatever reason we bought FHA the first time, we're going to see, can we maybe go conventional now? Because when we go conventional now, the PMI may be less. And think about how many people bought 2018. You'd be shocked at how many people might have 20% equity. So we've done a lot of those refinancing, not to get away from FHA, but just to look at other options. And conventional is going to oftentimes be the better one. So yes, and vice versa. I had somebody who they bought conventional 20% down. They're going through a divorce. Their credit's taking a turn. They have to refinance to get the spouse off, take a little money out. We have no way to do it except for an FHA loan. So, so you could refinance into FHA, out of FHA, no big deal. Closing costs are the same. That's another one too. The old days, FHA used to be higher closing costs. That's not the case anymore, at least with us and most lenders, I would even say. Closing costs are the same, conventional FHA. There's no difference. No minimum credit score I mentioned, like I said, that'll vary with each lender. Last 12 months, ideally should no late payments. Remember I said that manual underwrite. If you've got anybody who has late payments in the last 12 months, we're gonna really wanna know what's going on, what happened before, doesn't mean if you had a late payment the last 12 months, you can't purchase, but that's what we get at collections, judgments and collections. So judgments essentially means, you may or may not know it, but you went to court and lost, even if you didn't go, and money is owed, that has to be settled. That can be put as a lien on the property. So any tax judgments, personal liens, anything like that have to be settled. Collections, you'd be shocked, very rarely does FHA require collections to be paid off. It's shocking. They loosened up the rules like so much over the past 10 years. If it's medical collections, we're pretty much going to ignore it anyway. But even, $50, $60, $100, even if it's a few $1,000s, we're going to take a close look at it. I want to know what's going on, but we're pretty understanding. Charge-offs. So this is one that was a total 180. I can't remember when they changed it, but let's say I had my car and didn't make payments. It got repossessed. The car dealership auctions it off and says, okay, yeah, we got $2,000 for your car, so you still owe $8,000. We're going to charge it off. Don't do me any favors because that FHA will let some charge-offs go. It boggles my mind, but they don't typically require payment or action. Explanation at the very least. Obviously, if it's something recent, it could be a showstopper. But these charge-offs, they would be on your credit report for 7 years. So 2015, it may still be sitting on there. The good news is FHA is a path to get around that or conventional payment. Any questions on that? Okay.
So like with the judgment, is that something that would like it's on their credit report, or like does it depend on like if they literally just left work and it hasn't like shown up on their credit score, would it still be a feature?
That's interesting. It doesn't show up on credit reports anymore that the mortgage company uses, but it'll show up in the title search with the title company. So state liens, state tax liens are the ones we're seeing the most of right now. So this one, I think on one of the Tuesday meetings, Tiffany from GM Title talked about, if your name is John Smith, you could bet the title company to do a title search is going to alert state of Ohio has John Smith the tax lien. Then we have to the title company has to get John Smith to sign an authorization, mail that, or send it however they do to the state, and the state says we'll get back in about 2 or 3 weeks. Oh, why is it taking so long? COVID. We're still using that as an excuse. But because like, come on, they were taking a long time even before COVID. Now they just have a reason why. I just remembered this being recorded. So anyway, if you've got somebody with a common name, and this is another reason why, if you're doing a 21-day close, get that file to the title company, because these are things that could pop up in day 12. It's like, hey, day 12 is no big deal, except when you got 9 more days to close. So that's where these things sort of pop up. I don't even remember if I answered your question. Did I get there? Oh, how do we know about judgment liens? It is a question on the application. Are you currently defaulting any federal loans or student loans? Are there any outstanding judgments? So if the buyer knows of it, they should say yes. If they say no and they don't know of anything being out there, it'll turn up eventually. Any questions on that? All right. Non-traditional credit allowed. So perfect example, Chris and I have a buyer right now who by herself, she doesn't qualify. So she's having her mom co-sign for her. Mom's living with her, I should say co-sign. She's gonna be a co-borrower. She's gonna be on the mortgage also. Mom has Social Security, not a ton, $1,200, $1,400, but she's got no debt. So we're adding her income, we're adding no debt. It's gonna qualify for a higher price point, but mom has no credit score, nothing in her history ever. But we can use this showing non-traditional credit. If mom could show 3 forms of non-traditional credit: utility bill, rent payments, cell phone bill, car insurance that's paid monthly, health insurance. If we can find 3 different trades, we call them trade lines, though they could be eligible for an FHA loan and be just fine. So you've got a lot of, there's definitely different walks of life, different people who just don't trust credit and never wanted it, or they don't, they don't even put their money in the bank. That's a whole nother problem, no matter what loan. But, so there are ways around it, but it's always going to be difficult when you've never had credit before, and your first line of credit is going to be $150,000 mortgage. So look at it that way. Any questions on that? Okay, FHA property. You're like, all right, I'm a realtor. This is all I want to hear about. Finally, you're getting to it. So, what do you need to know as a realtor when you've got an FHA offer? First off, there's no higher cost for the seller. In the old days, going back before 2006, every FHA loan needed a pest inspection. That was $65. That's not required anymore. Unless there's evidence or concern about pests, we don't require a termite inspection. There also used to be a few fees, a tax service fee, and a few other fees that the seller had to pay for. I don't know if there's any lenders out there still doing that. Technically, they're allowed to, but that went away a long time ago as far as common was norm, especially for Northern Strip. What is still there is the appraisal. So anytime someone buys a home, typically there's an appraisal. If it's FHA, there's absolutely going to do an appraisal, interior appraisal. If I'm not mistaken, I think June 30th, again, being recorded, so I may go back on this, but there was an exception, due to COVID concerns where, the appraiser didn't have to go in if there were issues regarding that. I think that just expired, or it's about to. But right now, just assume every appraiser is going to be inside the home. The appraiser, back in the old day, there used to be the VC sheet, which was a checklist, 7 pages of appraiser walking into the home and just like a home inspection. Good, nope, bad, good, bad. That's gone, but the appraiser does still have to make sure the house is safe, sanitary, sound, secure, and that is a big part of what everybody is always worried. So I will tell you this, for every 10 appraisals that we have going FHA, probably at least 8, maybe even 9 come back absolutely fine. The general population never hears about those 8 or 9. They hear about that one that totally killed the deal because of the roof issue. Well, roof issue probably means there was a roof issue, and conventional site roof issues as well. But whatever FHA notes has to be remedied, has to be taken care of. The most common ones we see are handrails going up to the 2nd floor or going to the front porch. Drive through any city in Mayfield Heights or any street in Mayfield Heights, you got those 3 stairs going up to the front. If there's no handrail, FHA is going to have a problem with that. The good news is putting up a handrail, you could hire my father who has a wrought iron company, he's probably going to charge a pretty penny to put something real fancy and ornate. Well, he's retiring, so he could. But, or you can go to the bank, get a couple of, go to the Home Depot. I was going to say get a couple of 2x4s. That's even a challenge these days. But one way or another, you can put up a railing, and as long as it passes, you're fine. So it could be a relatively inexpensive repair. So the most common ones: handrails, smoke detectors, GFCI outlets, and scrape and paint. The windowsills, the garage, usually it's might be the west side of the garage. It gets a little bit more weather beaten. Scrape and paint, even if it's built after 1978, technically you probably doesn't have to worry about lead, but more often than not, that's going to be it. Those are going to be the most common ones that you see. If they see a roof and it's missing shingles or it's got 3 layers on there, the appraisers are going to say replace that roof. They're going to say go get a roof certificate. What a roof certificate is having a roofer go out there and more or less guarantee that there's at least 2 years of life left in it. So that's sort of what comes up. So I can tell you with most of the properties on the market right now, I mean, most people are putting this in, dolling this house up pretty nice. If you've got a house that's point of sale compliant, you probably don't have much to worry. But just be aware of what FHA looks for. And I don't go on appraisals. The only time I've ever been to an appraisal is when I refinanced my house. So you all would know better than me. But Colleen Nelson, how long is a conventional appraiser in the house? How long is an FHA appraiser in the house?
2.5 seconds.
Yeah.
Say the FHA one, it was like
Yeah,
less
it's
than
the
10
same.
minutes.
So they
But
say,
I
yeah,
will say handrails and chipped paint are probably.
Chip,
the top
yeah,
two.
chip paint is, if I have an FHA buyer, what I'm looking for mostly is chip paint.
Chip paint, okay,
But depending on the price point, when I take a listing, I note that to the seller that they may come up, so just to address it now.
that's perfect. Appreciate it. And Victoria, yeah, you're brand new, right? 4
Yeah.
months. So yeah, that's why I didn't ask you. And I'm sorry, what's your name? Yeah.
Victoria.
Oh,
Got
that's
it.
where I kind of was in a second. All right, that's why I was going crazy. Okay, thanks. Just when you're prepping a seller, getting the house all ready and dialed up, you know, if you have these things in mind, that's the safe list. And just let them know if we do take an FHA offer, we'll see what happens. If you don't want to replace the roof, you don't have to replace the roof. Obviously, probably not gonna be able to move forward. But you know, these things are gonna come up one way or the other. It's where kind of.
If you set that expectation up front, then there's no problem.
It's exactly, and that's why, in the past 12 months, 6 months especially, seeing so many FHA buyers miss out. Because, you know, I hate to see it because it's sort of like, you'd love to just sit down with the seller and just say, this is probably gonna be fine. Even if it is, might be a couple $100. Worst case scenario, absolute worst case scenario, you go back to whoever was offered to number 3. Obviously, that's not the easiest way to roll it out, but really that's my, I've talked to a lot of listing agents to say, hey, you know, make me feel warm and fuzzy. You know, why can't the buyer go conventional? I may or may not be able to share that. Technically, I can't without the buyer sharing. I may or may not get into that if the buyer really wants me to. But as far as the condition of the home, hey, what city is this in? Shaker Heights. Is it gonna be point self compliant? You probably got nothing to worry about. Okay, no, well, we're gonna, you know, they're gonna require us to seal coat the driveway. FHA doesn't typically require any seal coating in the driveway. They're worried about trip hazard and stuff like that. So most point of sales are even more strict than what an FHA appraiser is. So we can get the appraiser out pretty quick. As soon as the buyer signs the application, we're allowed to order the appraisal. Appraisers their turn times are coming back a little bit. So I would typically say, you know, 10 days is probably about, we would normally say 10 to 14 calendar days. We're probably sitting around that, but we can get that done as quick as possible. We can't have an FHA appraiser out there before there's a contract. Some people are like, hey, can I just have FHA appraiser come out and look at this before I list it? No, I mean, you could pay an appraiser to come out and give an opinion, but that's not going to be anything that's valid for the offer. So, any questions on that? I know there's a chat box here. Sorry, people at home, I'm looking for the chat box and I apologize if you're trying to grab my attention. I'll find it before we're done. Okay. We're only in slide 10. A couple of the weird rules. FHA, unless it's a bank-owned home, FHA requires a property has to have been owned 90 days before you can enter into a new FHA contract. So let's say an investor bought a house June 1st and they, you know, do whatever they're going to do, flip it, and they're going to put it back on the market August 1st, and it's on the market today. Buyer wants to come in and put an FHA offer on it. We can't use that contract. If you know, 90 days, give or take that extra day here or there. If the property was bought and transferred June 1st, September 1st is as soon as an FHA contract. Kind of a bummer, you know, maybe there's a handshake agreement or some sort of agreement that says, hey, we'll just write this in 25 days or whatever the calendar dictates, but unfortunately, that's just a hard stop. They put a temporary hold off on that for about 5 years, maybe even longer. They got rid of that. We're back to requiring 91 days. If it's been 91 days, but less than 180, we have to do 2 appraisals on it. So if a house is being bought at 100, the first appraisal comes in at 100, second one comes in at 100, we're good. Second one comes in at 95, we have to use that lesser. If the first appraiser requires no repairs, but the second one has a repair, we may have to deal with that as well. So you won't see this a ton, but it does happen. The buyer is not allowed to pay for 2 appraisals. So they pay for the first one. Guess who can pay for the second? The seller, the buying agent, the listing agent, and the lender. Guess who usually pays for that?
Lender.
Yeah. One of these days I'm gonna ask a question and get a different answer, but yeah, so we basically just assume, how do we know? Well, as soon as we know there's a property, Chris, myself, you know, any loan originator usually is gonna go right to the county webpage to double check the taxes. It's one more button to click, transfer, and show when the previous transfer is. And that's usually the way we kind of, sometimes things slip through the cracks. Sometimes you have one where, oh my God, this transferred 3 weeks ago, but it transferred from, you know, Tom and Susie Smith to Tom and Susie LLC or something like that. There are some exceptions, but generally speaking, you want to be aware of them. And make sure, especially if you're working with investors, that the seller doesn't change title from the time that you're under contract to close. Had that happened twice last year, where they were, well, my wife was gonna, or where someone was gonna be out of town, so they just quick claimed them off the deed. It's like, you're setting all sorts of other, you know, red flags, so just be aware of that. Any questions on that, or the two appraisals? Okay, here's a
If you
number.
have a deal that falls apart, it is FHA, and you have to go back on the market.
Mhm.
Does that appraisal price hang?
Great question. I'm surprised I didn't write that in here, but yes, it does. So an FHA appraisal stays with the property. It's 4 months is usually what they say,
Mhm.
but it can be extended for an extra 2 to be certified. So it does stay with the property. So if a house appraised for an FHA at 100,000, the deal fell through, you're reselling the house later and another offer comes in at 102, that $100,000 price is going to resurface at some point. That doesn't apply for conventional or,
Mhm.
but it does on FHA.
Okay.
So definitely be aware of that. I mean, that's one of those things too, where, you know, sticking with FHA, everybody's aware of the FHA addendum that says, you know, if house doesn't appraise for such and such price, you know, buyer can, you know, in essence, walk away and get their earnest money back. Now, of course, on page 1 of the contract, it might say buyer to assume any appraisal shortfall with, you know, within $5,000. That's okay to write on there, but that FHA addendum still does have to be signed.
Right.
And if it does fall apart, yeah, that price is still gonna be paid. Now, sometimes what happens, when the appraisal comes back, the lender has to log it in with FHA. There has been some times where the deal fell apart before it got logged, and it's like a real wishy-washy, hey, what's going on? And the buyer does have to pay for that appraisal. So if buyer A paid for the appraisal and it fell through,
Mhm.
buyer B, this is ridiculous in my mind, buyer B now has to write a check to cross country. We then have to pay Fifth Third or whomever to get that appraisal, and Fifth Third is supposed to refund the fee back to buyer A. It's kind of.
Really? Does another appraiser come out?
No, because you're just paying,
Okay,
you're refunding, and it's taking a long way to refund that buyer for the cost.
but the first buyer does eventually get the money
They're
back if
supposed to.
another FHA buyer?
Potentially, yeah, I
Huh.
mean, it's up to Fifth Third in my little example here to do that, but it's.
Do you think
This
it
is-
happens?
Huh?
Do you think it happens? Have you
I
ever?
assume it does, I mean, because there's, you know, it's not like Fifth Third has a balance sheet of just slush funds, so I'm sure it probably works its way out somewhat. But so that's
Thanks.
something new, I never
That's
really
interesting.
got a full understanding. So-
Thank you.
So this is where I mentioned the county limit, 356, 362, that's the base loan amount, maximum base loan amount, and then we can add the mortgage insurance on top of that. As I mentioned earlier, 2 to 4 family properties, I do have a higher amount. There are, I don't know of any 3, 4, 5, 2, 3, or 4 unit families where you probably need a higher 350 loan amount in Northeastern Ohio, but you know, we can. Benefits, so just recapping a little bit. Benefits using FHA buyers increases the number of potential buyers, as I mentioned. I think I said 1 out of 4. I said 20%. Sorry, I should be the numbers guy. That's 1 out of 5 buyers is FHA. And VA, by the way, makes up, I think, 7% of the total mortgage market. That might include refinances. So, you know, if you're ruling out FHA and VA together, you're taking out a big chunk of the market. Increased traffic, usually maintains sale price, list price, reduces time on the market, obviously if you got more buyers. One of the few ways to remain at 0 out-of-pocket expenses, because again, costs can be paid for by the seller. So there'll be payment penalty, discussion time. So 2 things I want to talk about. 203K, there's a whole nother class on that. So 203K is a way where you can buy a house for $100,000. Finance an extra $25,000 repairs or 50,000 or 100,000. Believe it, it's I would say it's limitless, but you can go pretty high for improvements. But you buy a house for 100, you're gonna put, remodel the kitchen, put a new roof on, that's gonna cost you $30,000. Your new net price is 130,000. Buyer can put 3.5% of that $130,000 down. The rate is a bit higher. The closing process is a lot longer. Pre-COVID, we normally would say give us at least 45, 60 days if it's 2 or 3K. Now we're saying 60 to 30 because it's a high demand program. Appraisers are moving slower and contractors have to rely on contractors. You can't do the work yourself. So we have to have contractors get out to the home. Contractors, even the ones who are best at their work, often aren't great with paperwork, let alone what a lender's going to be bugging for. So just keep that in mind. The other thing I was going to talk about here. So 2 things, 2 or 3K. It'll probably come up. So discussion time. Any questions about FHA? Any concerns? I mean, any experiences you had with FHA that you said, oh, yeah, here's what I dealt with. Just no.
So I know you and I have talked about, but like septic.
Septic.
Yes. Is there any restrictions, concerns?
So FHA, most septics now in Cuyahoga County, they have to be tested. Geauga County, where it's always been a pain in the neck. So if there's a septic, I should have put, if I would have known you were coming, Sam, I would have a septic slide just so you could. So let's walk through an example. There's a house for sale in Chesterland. I think that's Geauga County. There's a septic. Geauga says, okay, in order to sell this house, you have to have a septic inspection. Septic inspector comes out and says, it's failing, or maybe they can't test because the house is vacant. We need to make sure we can't close on that loan unless we know it's functioning. It doesn't have to be passed by Geauga County. We can still close as long as somebody says it's working. So we would allow it to close with an escrow. So not many lenders will do this. I should say not many. You want to know, some lenders clearly won't, some will, some will with exception, and it's going to be case by case. Even us, I would say pretty much we're going to do it, but technically it is case by case. So Sam has a buyer putting in an offer on an FHA home, and the county says the septic needs to be replaced, but we can't because there's not enough time, because it's supposed to close in 30 days. We will typically allow it. Used to be only for weather-related delays, but these days typically we'll go along with it. What we're going to require is go get 2 quotes, and the quotes have to be written, have to include these 8 items. And there's a lot to it. We have to make sure, that the person's licensed, find out how long it's going to take to complete, make sure that they're willing to do the work without 50% being paid up front. And we need them to clearly state that the septic is currently functioning. It may not pass based on city code or county code, but it is functioning. We're going to get 2 quotes. So let's say one quote is 12,000 and one quote is 14,000. We're going to take the higher of those 2 quotes and require 150% of that. That's $21,000 that we have to collect and hold into an escrow. We're going to want the work to be done within 90 days. We realize that doesn't always happen. It could be extended, but that's our typical requirement. That money could be the buyer's money. It could be the seller's money. It could be a combination of. We just need to know whose money are we spending first. Sometimes it's sort of saying the seller going, I'll put in 15, but you put in the other 6. And then we spend the buyer's money, seller's money first, and whatever's left over goes back to the parties, based on how they put it in. So septics, FHA doesn't require a septic inspection. So if this was in, let's say Trumbull County, I don't know if they have a septic requirement or not. Let's say they don't. Buyer can buy as is and just assume responsibility. And just like a well water, FHA doesn't require that. VA does. Those things do have to be tested, but FHA does that. That answer your question?
Yeah.
You could ask that question at the beginning, take your pizza and just run out. So, so it's definitely a bit tricky.
It's the same though, Sean.
It's a lunch and it's a education.
It's identical essential, yeah, you're right. You're
It's
exactly
just with
right.
the FHA, the cash usually isn't readily available from the buyer.
Yeah, it's probably even more limited. Yeah, I would say of the last 10 septic escrow holds I've done, the sellers probably put in their money at least 8 or 9 of the time.
That's how you write up the contract.
Exactly. I mean, when you get and a lot of times I get a call from the realtor going, hey, I got somebody, the seller's just tight, it's an estate or something, nobody's got money to put in, there's not enough proceeds here. what options do we have? It's like, well, bump the price up so that you can put it in, or, try and find a buyer who can provide those funds, but it's gonna be a small pool. And the biggest thing I tell any realtor is, if you have a house with a septic, before you even go out there and look, ask them, did you schedule your appointment with the county to have it inspected? Because that will save a ton. I mean, I think a lot of sellers are like, well, I'd rather just pretend like I don't know if it's failing or not. It's sort of like, you know what, you're putting off the indefinite. It probably is failing, but let's find it out now, because it's gonna slow down the process so much more. And septic companies are all backed up. Any other questions? Let's see if I can find the chat box. I'm sorry, chat people.
Danielle said there's nothing in there, sorry, she's on
Is there-
here,
Okay, cool.
and
Okay.
she said there's no.
We got a pretty good turnout. It's like at least 6 people online, so. Try some more pizza coupons or something. Actually, remind me for the next one, I'll tell them there's a lobster or something that they missed. Okay, so little plug about ourselves here. We're 2 o'clock almost on the docket, so I apologize. I actually ran longer than I thought, but cross-country mortgage, we've got everything out there. The only thing we're limited on, our construction loans are on hold. We don't do dot loans, and we don't do home equity line of credits. Everything else under the sun, we're pretty much doing. We're doing renovation loans. We're doing conventional FHA, VA. We're doing USDA loans. So next month, we haven't figured out if you want to see a particular program or topic next month's call, we're open to different ideas. It might be PMI, it might be VA for the next one, but just know, as I usually say during these, you can walk away not retaining any of this information if you just remember to Chris, myself, Don on the east side, the west side, phone call away. The example I always give, Nancy Emmerman, she's been doing this for like ever. She has an appointment on Sunday for a new listing, or I should put it this way, she has a buyer or an offer coming in with a conventional FHA and a VA. She may call me and say, Sean, I got 3 different offers, conventional FHA, VA. What do I need to tell myself? And I'll tell her from a cross-country standpoint and Sean Hadley's perspective, here's what you need to be concerned with. But it might not be a bad idea to call the loan officer on the pre-approval letter just to see if they have anything different from what I'm telling you. But just know, phone call away, whether it's sitting with your buyer or your seller, whatever the case may be, whatever's happening now. And for the new ones, anything questions. The nice thing, Joy and I were talking earlier about, I love this office. I've been with sorry, I'm going off the tangent here. You can stop recording if you want. I've been in this office for 15 years, and before working with Keller Williams, I was in another real estate office, and there were a good office. I won't say which office until we stop recording, but it was just sort of like stab each other in the back for a listing. It wasn't a real supportive atmosphere. I was intimidated just walking around. Here, you turn to the person to your right or left, they're going to answer questions, whether it's how do I log on to the screen, or what's a good script or script practice and things like that. That's why I love this office. I'm pretty excited to see people in here kind of face to face. But we're an extension of that. So my job isn't here just to take applications. My boss may tell me that in a sense, but we're here. We're an extension of Cross Country Mortgage to be sort of the on-site mortgage expert. So I kept a tally 1 month years ago, and I tallied it up. The phone calls I got, 1/3 of the phone calls I got were a transaction that had nothing to do with. It's to basically be a problem solver. It just sort of help you make you look a little smarter for that next sit down with a customer. So just know that. So Chris, I mentioned briefly, Chris Polak, he joined Cross Country 6 months ago. He sits, right, our doors are tandem to each other here. We're here 5 days a week, depending on, unless I've got a meeting at 3:30 or 3 o'clock outside the office. But ultimately, we're just a phone call away. And if you're here, stop by. So, ran over by 2 minutes. So anyway, that's all I have for